What if I told you that most traders don't lose money because they pick the wrong stocks? They lose because they size their positions wrong. Sounds surprising, right? The stock market isn't just a game, it's a battlefield. Every trade you make is a strategic move, and without the right position sizing, you're not investing, you're gambling. But here's the good news. The world's top traders don't leave their success to chance. They use battle-tested position sizing strategies to control risk, protect profits, and grow wealth systematically. In this video, I'll walk you through 8 proven methods that can transform your trading strategy. And stick around until the end, because I'll reveal a powerful hedge fund technique that could change the way you invest forever. Before we dive into the strategies, let's get one thing straight. Position sizing is not just about choosing how much money to put into a trade. It's about managing risk and ensuring that a single bad trade doesn't wipe out months or even years of gains. It's the foundation of long-term survival in the market. Think of it like this. Even if you have a winning strategy, poor position sizing can still lead to financial disaster. So, let's start with the basics and work our way up to the advanced techniques that separate amateur traders from seasoned pros. Imagine you decide to invest the same dollar amount, say $1,000, into every trade, no matter what. It sounds easy, and that's why so many beginners use it. There's no complicated math, no second guessing, just a simple, consistent approach that ensures you never overcommit to a single trade. But here's the catch. This method treats all stocks the same, completely ignoring the fact that some stocks are as stable as a cruise ship, while others are as wild as a speedboat in a storm. Would you really want to invest the same amount in a blue-chip giant as you would in a volatile penny stock? Probably not. And that's why many traders move on to a more flexible approach. Instead of investing a fixed dollar amount, the fixed percentage allocation method uses a percentage of your portfolio for each trade, typically around 2% to 5%. That means as your portfolio grows, your position sizes increase, and when the market turns against you, they shrink. It's a step up because it naturally scales with your capital. But here's where it falls short. Just like the previous method, it doesn't account for volatility. A slow-moving stock and a high-risk rocket ship still get the same percentage, which isn't always the smartest move. So how do we fix that? Enter volatility-based sizing. Here's where things get interesting. Instead of treating all stocks equally, this strategy considers how much a stock moves before deciding how much to invest. If a stock is highly volatile, you buy fewer shares to limit your exposure. If it's more stable, you invest more. This approach helps balance risk across your portfolio, making sure you're not unknowingly betting big on an unpredictable stock. Of course, it does require some calculations, like using the average true range ATR to measure volatility. But trust me, taking a few extra steps to protect your portfolio is absolutely worth it. If you love numbers, you'll appreciate the Kelly Criterion. This method takes a mathematical approach, calculating the ideal position size based on your win rate and risk-reward ratio. In theory, it's designed to maximize your long-term portfolio growth, ensuring you're risking the perfect amount on each trade. But there's a catch. It requires precise calculations. Get the math wrong, and you could end up overexposed and in deep trouble. It's a powerful tool, but only for those who truly understand their edge in the market. For traders who prefer a simpler, more intuitive approach, there's always equal weighting. Some traders don't want to mess around with complex formulas, so they go with the equal weighting strategy. It's exactly what it sounds like. You allocate the same amount of capital to every position in your portfolio. No fancy risk calculations, no adjustments for volatility, just pure simplicity. This method makes diversification easy, ensuring that no single trade dominates your portfolio. But there's one major flaw. Treating every stock equally can be dangerous. A steady, dividend-paying stock gets the same investment as a speculative, high-risk stock. And in the long run, that might not be the best approach. But what if I told you that hedge funds have a way to optimize position sizing using cutting-edge technology? This is where AI meets investing. Mean-Variance optimization doesn't just look at individual stocks. It scans historical data, analyzes risk correlations between assets, and finds the best way to allocate capital for maximum return with minimal risk. It's the same technique used by hedge funds and institutional investors to fine-tune their portfolios. Sounds incredible, right? Well, there's a downside. It requires access to advanced data and tools that most retail traders don't have. But if you're serious about taking your portfolio to the next level, this is a strategy worth exploring. Now, let's wrap up with two final strategies that focus on risk management. Both of these strategies are designed to keep your portfolio safe when the market turns against you. Value at risk, VAR, estimates the worst-case loss within a given time frame, helping you adjust your position size accordingly. Meanwhile, maximum drawdown-based sizing looks at how much a stock has fallen in the past and uses that information to determine how much capital to allocate. These methods require constant monitoring of risk metrics, but for traders who prioritize capital protection, the extra effort is well worth it. At the end of the day, position sizing isn't just about maximizing profits. It's about staying in the game long enough to see those profits grow. Whether you prefer the simplicity of fixed percentage allocation, the adaptability of volatility-based sizing, or the data-driven power of mean variance optimization, the key is to find a method that aligns with your risk tolerance and trading style. So, which strategy do you think fits you best? Let me know in the comments. And if you found this valuable, don't forget to like, subscribe, and hit the notification bell for more in-depth trading strategies.